I really do believe that great founders do look like anyone and come from anywhere.
The one thing that I have seen is just the mindset of founders coming out of Silicon Valley.
So I've definitely failed in my career as a founder. I've raised capital, I've lost money for investors.
The one thing that is consistent with all of these entrepreneurs that come in here that have been successful is they started or they worked in the service industry.
Was trying to raise capital sort of straightforward. You go down to this road and spend several days going from conference room to conference room. They all look the same.
Well, it's interesting because that last piece, it is really what I think founders have to be aware of.
The people whom I try to serve most are family offices, particularly first and second generation folks.
What are you doing for the portfolio? You as an investor, are you making introductions? Are you taking the late night phone calls?
America in general is quite good about this. There are entrepreneurs everywhere who are trying and trying and trying.
How do you manage all of these companies? What have you guys built to be able to manage, to be able to work with, and really be able to stay on top of your entire portfolio of hundreds of companies at this point?
We have 620 portfolio companies, 7 deals a month, 84 per year, 250 per fund.
Run those numbers back one more time. All right, everybody. I hope you're doing great. Welcome to an episode of the Skin in the Game podcast. My name is Saxon Baum, and I'm the co-host of the show. We are missing my dear friend and fellow co-host Tom Wallace today, but the show must go on, as they say in showbiz. So thank you all for being here. So excited to have a good friend of mine, Eric Bahn, not Baum, Eric Bahn from Hustle Fund today. Eric, how you doing, my friend?
Really good. So glad to do this with you. We're brothers from a different mother, right? So Bahn, Baum, we're merging it in today.
We always say, dude, it's like we look a little different, but we're exactly the same.
I think you look Korean to me, man.
I thought you were Jewish as well. Wait, that's not the case?
I love it. Yeah, well, we got a lot going on that's similar between our cultures.
Always, dude. Always. You were just telling me, got back from Singapore. How was that?
Oh man, I love any and all excuses to go visit Singapore. So for those who haven't experienced it, amazing city. It's like going to the future. It's an Asian culture with Western values. Everyone speaks English there. And in the fall, there's a bunch of events. Token, if you're on the Web3 side, Milliken, Super Returns, if you're on the more TradFi side. So a collision of people that all culminate into the Formula One race that happens every fall in Singapore. So got to catch up with some really great investors of our funds, good founders. It was a good time all around, and now suffering from the jet lag, but now energized because I'm speaking to you.
There you go. And you got SF Tech Week this week. You were telling me LA Tech Week the following week.
That's right. It's going to be a busy sprint, I think, between now and Thanksgiving, but that's the way that we like it.
That's the way that we like it. You sleep when you're dead. That's what they say, right?
That's right.
All right, bro. Well, hey, thanks again for being here. Hustle Fund, we're going to get into that. But before we get into that, your story is amazing and what you've built. Tell us a little about yourself. How did you get to where you're at today? A little bit about your background. And then once again, we'll dive into Hustle Fund and what you guys are working on.
For sure, man. So I'm the son of Korean immigrants who came to the U.S. in the late 60s, early 70s, around that timeline. And then I was actually born and raised in Detroit, Michigan. So Midwestern kid, had a great childhood in the Midwest. Detroit was a very interesting city to grow up. I've been mugged more than a dozen times as a kid in the city, but it was okay.
It's getting better. It's getting better.
It is getting better, actually. So the 80s and 90s were kind of a steep decline, but I think it's starting to J-curve its way out. And I will give a shout to Detroit in that, you know, at one time it was the Silicon Valley of the United States. From like the period of 1900 to 1950, Ford, General Motors, Chrysler, the auto industry was born out of that space. So it's a good reminder for me of like, you know, these kinds of cycles can be steep and the declines can be steep here. But now I moved myself 25 years ago to the other epicenter, which is Silicon Valley. I'm here in the San Francisco Bay Area, came out here for college. And I think one of the big moments that happened in my life was meeting all the women that I'm growing old with in the very first week of college in September of 2000. So I met my wife on the very first day of college. Everything has been better ever since that moment. Been married for
Amazing.
together 22 years, married, 2 kids. I met Elizabeth.
Congratulations. Congratulations.
Yeah, thank you, man. That's probably the best accomplishment in my life right there. And then that same week, I met my two co-founders at Hustle Fund, Elizabeth and Sheehan. And ever since, we've been good friends, co-investors, co-founders, investors in each other's businesses. They're more like sisters to me than anything else. So, in the intervening time before we started Hustle Fund, I was a media founder. I started 4 media companies, 3 that worked out well, 1 massive failure. And then was early at Instagram. And then 2017, that's when we launched our pre-seed investment shop called Hustle Fund, which is based here in San Francisco, but we do have a little bit of presence in Singapore as well, which is part of the reason why I go out there with some frequency. And I get to work with great human beings like Saxon in serving great founders like Zaid over at Flex, whom we were just talking about right before we hit the record button. And it's a joyful work, getting to work with these young builders and getting the opportunity to serve them.
Well, as we always say, we're brothers from another mother. I met my wife the first week of college. I grew up in Pittsburgh, a city that was the epicenter in the early 19th century and has made a serious comeback, which has been great. And then, as we always say at Florida Funders, and Tom Wallace, the managing partner, always says, what could be more fun than working with the next generation of founders, of builders, the most interesting and smartest people in the world? And that's what we love about VC. I mean, that's what it's all about. Hustle Fund specifically, though, is very unique. And when you told me this model, not only was I amazed, but also extremely intrigued. And you have since shown me the way of how you guys do things. But talk a little bit about Hustle Fund, how you guys operate, the uniqueness of the platforms and the different programs that you guys have.
I'll tell you a story that I don't tell too many people that happened before Hustle Fund that actually manifests, I think, the core thesis behind our work. So at Hustle Fund, there's a core signal that we are trying to ascertain in terms of the founders we're trying to serve, which is we want to back hustlers. For us, hustle means great execution, means high velocity. Highly experimental teams that are oriented towards measurement are constantly trying to improve the throughput of what they can ship each week, each month, each year, tend to grind out the best businesses over time. Now, about 14 years ago, I was working at Meta as a product manager, and I was trying to hire this one engineer. And this guy went to Princeton. Okay, he had worked at Google for 7 years. His interview was incredible. He actually had turned out to be this tall, handsome white guy with like a Patagonia vest. I was like, oh my gosh, right? Like everything is
our
there.
Guy. It's all right
this
there.
This is my dude, right? Like, yeah, like the phenotypes are perfect. The pedigree's perfect. Like everything's perfect. So we offered him an insane amount of money to leave Google, join us at Meta. And I was so excited to work with him. I was like, this is going to be a slam dunk. We began working with him. And after a couple of weeks, we quickly discovered like, actually, this guy is kind of dumb, right? Like, like he sounds smart, but he's like unable to ship anything. He can't orient his way around the team for the life of him. And after a couple months, we had to just like get rid of him because he was just an utter disappointment. And then like just contrast this with some other hires that I've made in the past. Like there's this one woman I remember who didn't even graduate from high school. She actually showed up to the interview in a strange, almost like pajamas outfit. So like some people on my team were kind of red flagging her, like, why are we even talking to this woman? Decided to take a risk on her anyway, begin working with her. She ended up becoming the 100x operator on our team, right? Just like the person who is driving like the core architecture of this massive project. So the reason why I share these concepts, these stories with you, Saxon, to your audience is I actually view the work that we do, you and me as pre-seed stage investors, as quite similar to hiring and recruiting. When you and I are writing those first checks into the teams, before there's any data behind them, we try to look at the pitch decks, maybe we'll try to look at their backgrounds, and all that stuff are interesting inputs, but you start to see the truth by working directly with people. And through the work, that's when you ascertain the hustle. So the quick summary of all I just shared in terms of how we invest, we begin with a first $150,000 check that we write into a lot of teams, 7 per month, 84 per year, 250 per fund. We'll then
How many employees do you guys have doing that?
4 investors, 31 people total. at Hustle.
31 total at the
Yeah,
Hustle Fund. Okay.
correct. Yeah, and a lot of
And
them are
run
actually
those numbers back one more time. So it was 7 per month.
7 per month. Okay, so we see 1,000 deals each month, 12,000 per year. Of the 1,000 that we see, we'll write an initial $150,000 investment into about 7 teams per month on average.
Okay.
So if
Okay.
we like the ideas being presented and we want to understand how they hustle, we'll write that first check. Then we'll move on to a growth project for 8 weeks, usually related to sales or user acquisition. We have a school on growth. We pair them up with mentors. We'll start to sprint with the founders on a metric that they care about. And as we work with them, we can get a much better sense of seeing how the founder hustles, see how they operate, learn more about their market. And that's when we can find the truth in our view, the true due diligence of like what these teams are capable about. And then 20% of cases thereafter, after that first check, run the growth project. In that subset of 20% of cases, we determine that founder Saxon is a true hustler. He's in the market that we love. We're going to double down with a second $200,000 investment. So that's how this model has been working for the last 4 funds.
So is the maximum check that you guys will write 350,000 all in?
Cumulatively. That's right.
Got it. So it's interesting because a lot of investors talk about you got to keep on writing checks. You want to continue to just hammer your winners. And that's what we do. You know, like Zaid, for example, we were talking about, we invested in the pre-seed, the seed, the Series A, the Series B. It's our largest position in our second fund. And we've got, you know, several $1,000,000 in that deal, and hopefully it works out. How does the math work if you have 350K in deals rather than, you know, having a few million in 2 deals?
Great question. So with founders like Zaid, who's building Flex, everyone should check out Flex.1. It's an amazing
Flex.1.
platform.
Great
I use it
product.
myself for our fund.
We do too.
We have participated in every round as well, but in a different way. So
Okay.
in terms of those first 2 checks out of the fund, we are really, really valuation sensitive. So the way that you make your money in pre-seed, I think, is an entry point. If you can get to the lowest valuation possible and get the conviction as quickly as possible, then you generally get rewarded with the alpha. But when it comes to like the post seeds, the Series A, the Series B, wherever, we run SPVs. And at that point, it's dealer's choice for our LPs and our community to participate. So we have a lot of money into Zaid's company as well.
Got it. And then you guys will take your typical fees on those SPVs. So although it's not coming out of the fund, you guys are still getting economics on those.
Exactly.
Deals.
It's like at 0 and 20 for those SPVs. So no management fee, but the carry if it works out.
Got it. Got it. No, that makes a lot of sense. When you guys are looking at pre-seed deals, I just want to double click on that. Price sensitive. For a pre-seed deal, what is price sensitive? And then do those companies typically have an MVP yet? Or is it still 2 guys in a garage have a good idea?
Great questions. So entry point on average somewhere hovers between $5 and $7 million on a post-money valuation or post-valuation cap on a safe. I can go a little bit lower than that or a little bit higher. There's some variance. And in terms of like the persona that we're trying to serve here. So in 70% of cases, Hustle Fund is the very first investor, even before mom and dad. And normally that is a team of co-founders who just quit their jobs, maybe a couple of weeks or months ago. They have an early prototype, very little traction. I love that kind of archetype, actually, of personas to serve.
What do you think about experienced founders versus first-time founders? When you're going this early, like when we go this early, which is give or take about maybe 20% of our fund, we typically will not be investing in first-time founders because if we're going this early, as you said earlier, you are fully betting on the hustler. You're fully betting on the guy or girl. So for us to feel comfortable with that, we will only invest in experienced founders that early. How do you guys think about that?
I mean, I have love for both types of founders. On the experienced founder end, there's certainly a level of de-risking. Like when I was much better as a founder in my second and third company as I was in the first. I mean, so many mistakes.
See the blind spots, you know, a little bit more.
Yeah. But the trade-off is as follows. Like it does correlate with the more experience that you have under your belt with higher valuation. So entry point can tend to be a little bit on the higher end when you get to serve those kinds of founders. The majority of our founders, I'd say about 60%, maybe 55% are first-time founders, though, that we back.
Okay.
So even though you're taking in higher risk on a team that has a lot more to learn, we think we get offset and rewarded by the alpha by being able to come in at a much lower valuation than normal. So because we have a large index, essentially, it's okay if we have a lot of failure within our portfolio. It's designed to work like that. And taking earlier risk on a first-time founder is totally fine for us.
What about age of founder? That's another thing that I don't want to say that we don't invest in old founders because that might get me shot in some parts of this city, but we typically are not investing in founders that are over the age of 50, let's just say. How do you guys think about age of founder?
I think our oldest founder that we've backed is 62 ever.
There you go. There you go.
So I don't mind older founders so long as they have really fit five things for us: team, problem, solution, market, and traction. If they have good answers as to why their team is the best on those five dimensions: team, problem, solution, market, and traction, I'm okay with it. But I will say that if I were to look at the average age of our portfolio, it does veer towards somewhere in the 20s,
Okay.
largely by virtue of we do back more first time founders. So they
Mhm.
tend to be on the younger end of it. But I mean, what there's I think a quote I heard once from like a B2B SaaS founder. I forgot his name. It was his first company that he was doing around like 44. And someone asked like, how did you get such an incredible traction? You went from like 0 to 100 million in like 3 years or something. Like, what's the secret? And his response was like, the secret to my overnight success is 15 years in running enterprise sales at like another company, right? And
Yeah.
I really dug that answer, which is like that kind of cumulative experience has to count for something in this game.
Yeah, I mean it's also when you have so much experience with buyers, you know where the doors are, you know who to call, you know who to open, and then you know how to work those channels specifically on the enterprise because we see that too. I mean, enterprise sales are hard, so for a 21-year-old kid, they don't might not know which way the river goes, but for somebody that's been doing it for however long, they know how to work those channels. Specifically on the enterprise sales side is what we've seen. Another question around this. Silicon Valley, where you live, is the mecca. 80-ish% of all venture capital dollars go to Silicon Valley. Rachel, the head of our deal team, has been in San Francisco the past week. She was at A16Z Speedrun. She
Great.
was meeting with some big investors. What do you see in terms of young founders coming out of the Valley compared to coming out of other places? Is there a core difference in skill set that you see, a core difference in mindset that you see, or we back the best founders no matter where they are, no matter what age they are, as long as our five things match up?
We have a mantra within our fund that you have to believe in order to work at Hustle Fund, which is that great hustlers look like anyone and come from anywhere. Full stop. Now, I would say that Silicon Valley is probably the most represented
Hmm.
geography when it comes to the founders that we've backed historically. But that said, I really do believe that great founders do look like anyone and come from anywhere. We're kind of at a point where, let's put it this way: 15 years ago, there might have been a stark difference between a founder that you spoke to in Silicon Valley versus a founder in Florida or Pittsburgh or Detroit or Singapore, et cetera, because there's an asymmetry of information. Just like those in the
Yeah.
Bay Area just tended to be better educated and have like the better embedded networks and so forth. But fast forward to the present, 2025, as of this recording, the internet has sort of done its thing in democratizing knowledge in a really effective way. Like talking to a founder in South Florida or in Tampa, even, or anywhere else, they sound exactly the same as a founder in Silicon Valley. So if they can make the case as to why they can flourish in wherever region that they are, I'm totally fine with serving them. The only case where I find that Silicon Valley could be a compelling option is there is a density of talent that exists
Yep.
here.
Yep.
So that is a real value. However, you're also paying for it. And I do think that there are plenty of amazing engineering graduates coming out of University of Florida that are being totally overlooked right now that will probably be a little bit less expensive than like a Stanford graduate right now, but as capable. So, there's different kinds of levers that you can pull for advantages and disadvantages in both geographies, or all geographies, I should say.
It's exactly how we think about things as well. I mean, we believe secondary and tertiary markets can be as effective in terms of founders coming out as primary markets. Once again, as you said, primary markets, you might be paying a little bit more. Maybe there's better access to talent. The one thing that I have seen, and I'd be interested to get your feedback on this, is just the mindset of founders coming out of Silicon Valley. Because there's been so much success in that ecosystem, they have this grow as fast as possible, break shit on the way, grow, break, grow, and just go all out making this happen. And I feel like the rest of the country has about 80-ish% of that, maybe 90 in some places, but I do think they're is that mindset that I've really only seen in Silicon Valley that, the young kids specifically, like, we can change the world with what we're doing.
So I've definitely failed in my career as a founder. I've raised capital, I've lost money for investors. I've also seen the other side of it of making money for my investors and so forth. And here's one thing I really do celebrate about the unique culture of Silicon Valley. When someone starts a company, Saxon and Eric, let's say we try our best, it doesn't work out. When you talk to anyone in Silicon Valley, they don't say like, oh, like it sucks you lost your money, or like, it sucks that you failed. They always start with, what did you learn? And then when are you going to try again?
Yep.
Right? It's those two things. And that I think is something that is so positive mindset, is that there's no concept of failure here in Silicon Valley. There's only the journey of learning. Right? Now, I think America in general is quite good about this. It may not be as starkly felt in markets like Detroit or in South Florida or anywhere else, but it's there. There are entrepreneurs everywhere who are trying and trying and trying. But I just came back from Singapore. We were just talking about this earlier. And when you compare Asia or outside of the rest of the world to even America, man, failure is a big deal there. It's like you shamed your family for losing all this money. Like you're
need to
unemployable for
leave.
life. You're
You
never
are
going to get
banned
married
from this country. You are not allowed to come home until you get married and have kids.
Exactly. Or even if then, like maybe not. Like it's a serious kind of cultural difference here too, which is why I'm still so long on America. But again, like going back to what we were discussing earlier, I do think the mindset of Silicon Valley is starting to democratize, because there's been so much education from like podcasts and education initiatives from Florida funders and Hustle Fund and elsewhere. It starts to get easier to adopt, I think, this kind of mindset of experimentation and appreciating the journey along the way. So maybe 10, 15 years ago, I'd say like, yeah, there's a big difference between a Florida founder versus a California founder. But I don't know, man. I think the gap is starting to shrink a bit.
I agree. And I love to hear that specifically coming from you, who sees probably more founders than anybody I know. There's two other core topics I want to get into, but before I get this, I have a bit of an obscure question. I was speaking at a school, a local prep school here in Tampa, who every week or so, they bring in a local entrepreneur to talk about their story. And the professor said to me, the one thing that is consistent with all of these entrepreneurs that come in here that have been successful is they started or they worked in the service industry at some point. They were a bartender, they were a barback, they were a busboy, they were a waiter. And I started to think about that. I came from that industry, and the hustle, the hustler term to me is synonymous with that industry. Any stats on how many of your founders, successful founders, came up in the service industry?
Oh, damn. That's such a good question. I don't know what the statistics are off the back of my hand, but I'm with you on this thesis. My very first job out of college was as a technical support agent for Intuit, taking angry customer phone calls all day long in Tucson, Arizona, in a warehouse. Right. In high school, like I installed HVAC systems with a local HVAC guy. And I will say that, learning how to appreciate working with your hands, dealing with customers, like the emotional intelligence training is something that I still use to this day. And this might be
100%.
actually a little bit of a criticism to like some of the founders who perhaps like had this amazing kind of pedigree journey, maybe lived in a little bit more of a bubble. And then when they're finally asked like, hey, are you going to pick up the phone and call business to try to sell your product? They're too afraid to do so. Right. Like sometimes you got to just like dial for dollars, especially in the beginning. And those who do come from services backgrounds, which I think a lot of our portfolio probably did, as well as yours at some point, like you can sort of feel that they have that street smarts that they're employing right now.
Yeah, I all those things that you said is exactly how I think about it. You have the ability to even strike up small talk. I mean, small talk, yeah, people might not love it, but that's how you start a good conversation. That's how you start understanding people. Those are all things that a good founder needs to do to be able to sell. To your point early on, nothing else matters. Doesn't matter how good your product is. You need to bust down doors and sell. And if you're afraid to have those conversations, you're never going to put yourself in a good position. All right, let's move on. Love what you're doing at Hustle Fund. Your background is media. At this point, I think we're seeing something very exciting. And you guys definitely are really, really playing into this. And we are as well here at FLF. The intersection of media and venture capital. it seems like this is like the time. If you're in venture capital, it's no longer just the old white guys sitting in the office making decisions from their big chair. It's all about content. It's all about being on the streets. I have been using the term have our founders be our influencers. How has media infiltrated venture capital, and what's the future of venture capital and media look like specifically for you guys at Hustle Fund, who are some of the best at the business at it?
Let me take you back 20 years ago to 2005 when I started my first education startup. So back then, there were maybe just 100 VCs that mattered, and they all had offices on Sand Hill Road. So when I tried to Sand Hill Road in Menlo Park, California, in Silicon Valley. And so when I was trying to raise capital, sort of straightforward. You go down to this road and spend several days going from conference room to conference room. They all look the same. There's a bunch of dudes in like Patagonia vests who are just looking at their Blackberries,
Back to the
barely paying
Patagonia
attention.
vest.
Yeah, and it
There's
was like
something
pitching.
there. There's something there with the Patagonia vest.
Dude, it was like a Patagonia vested Caesar situation where they're all just like, nope, nope, yeah, nope, nope, nope. It was pretty much all no's for me, right? And the reason why was essentially there's a gatekeeping situation where there's a oligopoly of 100 VCs that had pretty much most of the VC money, and they didn't have to do much. Like they didn't have to invest in media. Like founders would make the effort to find them because there's so few gatekeepers of capital. Fast forward 20 years, we got Saxon, you got Eric. We're both running our own emerging manager franchises here, but there are thousands of venture capital firms. And on top of that, tens of thousands, if not even 100,000 angel investors out there too. So the early stage ecosystem where you and I operate has become far more democratized, where founders more than ever have choice of where they can select and choose and accept capital, right? So it's not enough now for us to say, like, I have money, I want to give it to you. Will you take it? Founders are now starting to ask the right questions, which is, well, Saxon, well, Eric, what can you provide to me that's beyond money, right? And so these kinds of media activities that we do, which are really over indexing on things like founder education or producing like a big surface area where we can provide and offer surface area. Like if I become your founder, maybe someday I can be your podcast guest and I can talk about my company and then, get a huge audience and some revenue that comes about. These are the things that founders are starting to ask more about. We know media because that's our backgrounds, and investing in things like a large newsletter that reaches 500,000 people a month, our events, we do 30, 40 a year, our big angel investor community called Angel Squad. They're really great for that kind of surface area for our brand. But in addition to that, that's the value add for our founders. Like we can promote you through our newsletters and drive your first revenue. If you need mentorship, we can go into our angel investor community and find the right experts for you. That is the service quality of venture capital today that I credit A16Z for introducing, the services model for founders. And I think that is a far healthier way to approach venture capital, but you have to work your ass off too.
Well, it's interesting because that last piece, like, it is really what I think founders have to be aware of. You now have a lot of buzz out there. You got a lot of people on Instagram. You got a lot of talk about how, hey, we're great investors. We're going to do this. We're going to do that. You still have to dive into what are you doing for the portfolio? You as an investor, are you making introductions? Are you taking the late night phone calls? What are you doing for your portfolio? And, I think that something that a lot of emerging managers struggle with is fundraising. It's how do you raise from the best LPs? How do you raise from family offices? How do you get out of just the wealthy individuals? And so one thing I wanted to ask you is, institutional fundraising. Is that something that you guys are keen on? Or do you guys still really, or not still, but do you guys prefer to work with family offices and individuals? What's that mix for you guys with your funds?
That's right. So for our current fund, we do actually have some pretty substantial institutions. We have a sovereign wealth fund. We have a fund to fund. We have an endowment as well. So they are an important part of this ecosystem for us in our LP base. But I would say that the people whom I try to serve most are family offices, particularly first and second generation folks who have had direct experiences in building their companies. A lot of what we're talking about here is dictated by fund size. We're only raising $50 million for any given fund. We never want to go beyond that because we like the pre-seed small check focus. And that's not
real quick, Eric, if you guys do 50, this year, when's the next 50 that you'll do? Is that annually? Is that every 2 years? Every 3 years?
Every 3 years. Yeah.
Every 3 years. Okay,
A
got it.
typical venture cycle is usually around 3 years. 3 years.
Yep.
So you tend to find most funds doing around every 3 years too. And so the family offices are the most fun, honestly, because they're the ones who've actually generally directly hustled their way to build their wealth and understand what we're trying to do, but are also willing to roll up their sleeves to help our founders too. All right. So that's a different part of the social contract of LP relationships that's changed a lot in the last decade, is that the LPs
Yep.
like to be involved with the founders and form those relationships as well. That's the most fun. Now, if you and I are going to start like $1 billion growth stage fund, we have to do that through institutions. That's going to be the better money and the more appropriate size to catch those like $100 million checks. But for our small fund, like we want like $5 million max from like a given LP. That's fine for us.
Yeah, and that's same with us. I mean, it's the interesting thing though is you have a lot of these, I think, younger investors that are really trying to make a name for themselves, and it's very hard for them to raise money because venture capital is still about results. It's about traction. Are you making money for people? So it's that sort of balance of being out in social media, being this media company, but also being able to build this institutional shop, being able to build great processes, procedures, recruit great investors, and then produce great returns. And so I think it's that balance as an emerging manager.
It is. And also, I'll throw this in here too. And I think this is true for you and me, which is the profile of who is starting a fund has changed a lot in the
Big
last 10
time.
years.
A
Yo,
lot
like
less
10,
Patagonia vests.
well, they're still out there, and I do own one. I just never wear it. But like, it's the weather's warm enough in California, so like, I would say that the typical persona of someone starting a fund years ago is like, oh, I was like at Goldman Sachs, and then I went to Harvard Business School. I worked at Sequoia, and then broke off, and then like I'm starting my fund now. Very very finance background driven, but now most emerging, maybe not most, but a lot of emerging managers are guys like you and me. Like we were founders before. We
Yep.
actually struggled to create companies. It doesn't matter whether we even succeeded or failed. Like, but having that kind of empathy that we bring into the relationship of founders, that is actually one of the also kind of nuanced advantages I think that guys of our profile, not to be too self-congratulatory, have, because we understand how hard it was, right? And we can play
We've
a little
been
bit.
in the car. We
Yeah.
have been in the car, and now we're not driving the car, but at least being in the car, being able to help. Couldn't agree more. I mean, that's why if you talk to our founders, I think that they would say, hey, we love working with you guys because you were founders. You've been in that car, you've been in our seat, and you can help through really not just the financial challenges, but the operational challenges.
I like that analogy actually. Yeah. So maybe we're not in the
You can
car
steal
anymore,
it
but
from me.
we're the pit crew. Or
We're the
like
pit crew. I like that.
yeah,
Coming
yeah, or
straight
the
off of F1. Yeah, I
manufacturer,
like
right?
that.
Like yeah,
Yeah, there
exactly.
you
I'm a
go.
big F1
Yeah.
fan.
You guys have an insane amount of portfolio companies. You have built a system and a process like I have never seen before. You don't have to give away all of your secrets on here. This is a recorded line, so don't give away everything. But tell us a little bit, how do you manage all of these companies? What have you guys built to be able to manage, to be able to work with, and really be able to stay on top of your entire portfolio of hundreds of companies at this point?
We have 620 portfolio companies
620 portfolio companies.
so far across 4 funds, and we're still going to keep going. 7 deals a month, 84 per year, 250 per fund. Now, I'll go back in time and tell another meta story. So when I was a product manager there, we would run lots and lots of experiments, changing the product, trying to see what user reaction was, and so forth. And a small experiment had a minimum of 10 million users that we were trying to test in front of. 10 million. Okay. And so one of the things I kind of learned in my experiences at Meta, but also just in Silicon Valley, is that people are very good at handling a lot of data, and you got to kind of just get used to that. So just applying that kind of mindset into the work that we do in venture, I actually think this is more of like a product and technology platform. And as such, we've invested in a lot of technology to gather data and key metadata on the companies that we're trying to review, systematizing everything through CRMs and cool databases, in terms of consolidating our notes, trying to compare the competitiveness of a given company across other companies that we've seen in the past. This is just a data problem. So being able to keep up with our portfolio is actually fairly chill, and that we've been able to merge two things. And this is my unsolicited advice for managers out there who are also thinking about getting started. The first is that having a really clear data input system. So we never data ourselves from the founders. We always have the founders provide their updates even if it's in like sort of unstructured format, we can now use AI tools to sort of structure the data for them. Example would be like Saxon sends me an investor update and he shows like his revenue numbers, his burn, like who he hired, if he raised more money. It might be all just written out, but we can turn that into a database format just now very easily with AI. So that helps us to track companies very passively. But the second thing too is by having this large community of mentors that we sign with our founders, they can provide us the better points of contact on a day-to-day basis because they have more industry-specific knowledge to share. And that's a relationship that we actually lean on very heavily at Hustle Fund to get a sense of like, oh, Saxon's like women's health like company is actually inflecting in the right way because of like this rare like Medicare compliance thing that sort of changed. Like
my women's health company is doing very well, by the way.
Exactly. I knew
extremely
it would.
well.
Yeah, I'm going to double down with our second check any moment now. So that's like data and like community, I think, is not getting more accessible to merge together. That allows us to track like a very large portfolio. So at this point, we can run an audit in our fund every week, and which is what we've been doing.
Yeah. What you showed me is some of the most amazing technology I've seen from a system standpoint from any VC. Tried to steal a little bit of it, which we implemented. Only with 110, 111 portfolio companies now. But yeah, it's just amazing what you guys have built. Final question, and it's the hardest one of the day. What are you most excited about in the portfolio right now? That could be a company, that could be a trend, that could be anything, but something in the Hustle Fund portfolio. What are you most excited about?
That's a hard one. It's sort of like picking who your favorite child is right now, right?
That's why I said it didn't have to be a company, because I don't want you to on camera have to say who you really love the most.
I'm going to pick one right now. So let's put my feet to the fire. I'm really excited these days about Scott Hickel, who is the founder of Throne. So Throne is creating Whoop for poop. So what it does, it is a computer vision sensor that you put on the rim of your toilet that is pointed directly at the toilet bowl. And the reason why I'm so excited about this is every day, Saxon, you and I are literally flushing away data. You know, your poop actually has a lot of health indicators. There could be occult blood, which could be a symptom of colon cancer. There could be, even like the consistency of your bowel movement and so forth has actually real bearing on health outcomes that we are completely ignoring. So being able to put a little sensor pointed at your toilet bowl provides some key biomarkers that can direct your health. This requires zero change in terms of your daily behavior, but can have dramatic upside change in terms of giving you the data that you need to change your own health outcomes. So Scott just recently poached one of the co-founders of Whoop, one of the best health sensors on the planet. And they're building this toilet sensor right now, and it is remarkable. I've been using it for the past year. It is amazing.
Very cool. Is it integrated in with an app that you can see this information? So you don't actually have to send any samples anywhere.
No, see, that's the thing. Americans don't want to like poop in like a container and grab it. Like that's disgusting, right? That's not for us, right? But being able to just like detect it with smart computer vision, a little bit of AI, put it into an app, send it to your doctor, put it with your health data, that I think is great. And also like putting it into nursing homes, because I actually think that elderly populations have the most to gain with these kinds of data to start. It's an awesome product.
Love it. Whoop for poop. You heard it here first, people. Eric, thank you so much. It was so good to see you. Good luck in SF this week. Good luck in LA next week. Come and see us down in Florida. We miss you down here. And for all of our listeners, if you liked today's episode, throw us a like, throw us a follow, share with your friends. And if you want to be a guest, let us know. You know where to find us. Thank you so much.
Thank you, Saxon. Appreciate the opportunity. And Florida Funders is one of my favorite collaborators. Founders, you should work with Saxon and team. They're the best.
You as well, brother. Thank you for everything.